Ladies and gentlemen, welcome to the Business Brew. I am your host, Bill Brewster. This episode features Wes Gray, also known as the Alpha Architect or the ETF Architect, however you may know him. For those that don't know, I think you're going to learn a lot about ETFs. Wes has a number of ETFs that he manages. The most interesting one that I can think of as far as like a current event ETF is kind of the BOXX, BOXX is the ticker. It's potentially an interesting thing to consider as a cash management vehicle in lieu of treasuries. I would encourage you to open up the prospectus and maybe take a look at that. He also has a value ETF and a momentum ETF that we talk about, and he's got an ETF business. So if you are someone that runs long, I guess the perfect connection is probably someone that is long only, lower turnover, and I would just describe it as more Buffett style. I don't know if that's exactly the right way to say it, but that's the way that I'm going to say it. So anyway, consider reaching out to Wes and we'll see. But I hope you enjoy the episode. I certainly enjoyed talking to Wes. He's a great guy. He served our country. It's nice to see him succeed. And I think he's succeeding by helping other people succeed, which is win-win and highly endorsed on this program. This episode is sponsored by Daloopa. Daloopa is founded by a former hedge fund analyst to bring simplicity into the investment process. Daloopa offers an AI-driven single source for all company-reported data and allows for investment teams to make the most informed decisions in the shortest amount of time. Daloopa scales the velocity of an investment team's idea generation. Analysts spend less time locating and manually inputting meaningful disclosures into Excel and more time synthesizing in the minutes after the print. Daloopa captures data from all company-reported sources, including from footnotes, MD&As, and investor presentations. Daloopa's data sheets include GAAP to non-GAAP adjustments, guidance, and all company-specific KPIs. Each data point is auditable to the source for easy verification and accuracy. Daloopa's Excel plugin can also update your existing models for the latest quarter in just a single click. Bulge bracket banks and major multi-managers are trusting Daloopa for their use in initiating coverage, building and maintaining industry dashboards, and keeping their models up to date. Visit daloopa.com/businessbrew to create a free account and learn more about how Daloopa can increase your team's speed to differentiated insight. As always, nothing in this show is financial advice. Please consult an investment advisor before making investment decisions. Everything in this show is for entertainment purposes and educational purposes, and do your own due diligence. All right, ladies and gentlemen, excited to be joined by Wes Gray, the Alpha Architect. Wes, how you doing?
I'm good. Honored to be here.
Oh, well, thank you. I'm honored to have you. Happy to have a program that warrants a guest like yourself.
Yeah. Well, you put a lot of time in. I'm sure you get some knuckleheads like me to communicate a few things every so often.
Well, you're far from a knucklehead. I guess I first found you with the book you co-authored with Toby. And then I've read most of your stuff, so I appreciate what you put out there, and I think the ETF business that you've created is pretty interesting, so I'd like to have a discussion with you about it if you're willing.
Of course. We dig in.
All right. I guess the first thing that I'd like to talk about, because, it seems timely, is this BOXX ETF that you have, and I'm not sure that enough people know about it as a potential strategy for cash management. So do you mind talking a little bit about what you do and how this product came about?
Yeah, unfortunately, it's a long story. I'll try to condense, but it's probably about 7 years in the making. And it's an accumulation of every skill set. We've been building for about 15. And then just it all came together to create like what's arguably or probably the best idea we'll ever come up with, frankly, because it's just, sometimes you only have so many good ideas in life, and then you get a really good idea, you're like, holy cow, I'm never beating that one. Like, I feel like that's BOXX, right? And so long story short, I'm sure most of your audience aren't former option market makers or prop traders, so I'll try to explain this as simple as possible. But essentially, within the options market, there is a direct to consumer lending market through what they call box spreads, where just the math of put call parity, you can isolate either to borrow or lend directly with other option dealers or other option market participants, or really any market participant, right? And back before the 87 crash, people would do box spreads, like Susquehanna would go talk to whoever, Jane Street or Citadel, whoever their names were back then. But the problem is it was just over the counter, and you always had counterparty risk, right? So finally they got the box spread trade cleared through OCC, which now you have like a centralized counterparty that means like, hey, now I can just go to the market and borrow and lend through the box spread, and I don't care who's on the other side of that trade because there's a clearinghouse that can manage all the counterparty risk, right? Just like they do in stocks with DTCC and like in futures and other marketplaces, right? So that's like the deep history on it. Now, so how the hell do you actually do it? Well, so if you're basically replicating a treasury bill at whatever duration you choose. So for example, if you're going to do a 3-month box, what you need to do is you're going to have 4 option positions. 2 of those options are going to replicate a synthetic long stock position. That's going to consist of long a call and short a put at the same strike price. And I don't know if you remember like your payoff profiles with options, but if you long a call and short a put, you basically...
Yeah, it's just a synthetic long.
Yeah, synthetic long, exactly. And then that's one part of a box. The second part of a box is the synthetic short, where now you're going to buy a put and sell a call.
Sell a call.
But at a different strike price. And that difference in the strike price is the amount of cash flow that this trade will deliver whenever those options are going to settle. Like let's say 3 months. So for example, I'm synthetic long, synthetic short. Obviously that mechanically eliminates all market risk. And what it's going to do is, let's say you did the long synthetic at 1,000 and you did the short synthetic position at 2,000. What's going to happen is that trade will deliver guaranteed, at least as guaranteed as the option clearing corporation can guarantee it, which is pretty good, that you're going to get $1,000. And of course, if you know that there's a payment that guarantees $1,000 3 months from now, that's backed by a double A rated agency, it's not going to sell for zero. It's going to sell for something probably close to T-bills, right? Because it has very low risk and you're guaranteed a payoff. So it might sell for whatever, $900 or $950 or whatever the interest rates are, right? And so, and that's the lending side of it. You can also short a box and you can implicitly borrow from the option markets, right? So this is just a huge funding market that's pretty well established in like hedge fund, prop trading, and market making world, because it's a way for them to go around the banks. You don't have to go borrow from your broker or lend money to your broker. You can just go directly to another counterpart in the marketplace and trade with each other to borrow and lend capital. So that's what box spreads are. And then what we thought about is like, well, no one's ever done this before in an ETF. But boy, would it be nice if I could get the box spread somehow in an ETF, because one, it generally has a preferable return profile relative to just straight up treasury bills. But more importantly, it might have a preferable tax profile because we can leverage a lot of our knowledge with ETF, like in-kind rebalance or what have you, to essentially create something that presumably might be, more tax efficient. And that's basically what we did. It took a long time because every single time we tried to do something, people would ask us, well, what are you talking about? How does that even work? So it's just, and no one's ever done this before. So every time we get to another counterparty or what have you, it's just difficult. Like even right now, FactSet, Bloomberg, and Morningstar don't have the holdings data correct with the box. And, it just is what it is. Like sometimes when you're a little bit too innovative, all the other counterparties, their systems aren't really designed to really think about this. It's a continuous putting fire out problem, but it's just the cost of, being out on the tippy spear, I guess. But anyways, it's obviously
okay. So wait. So if I'm synthetically long, what, S&P at 1,000,
it can be on any asset,
and then
by the way. Most common
yeah, I'm
is
just thinking
SPX.
S&P because it's
Yes.
easy. And then I'm going out and I'm shorting
Yep.
it at 2,000 in 3 months.
Yes.
What you're saying is that trade should theoretically cost like $900 and some odd dollars to throw on, whatever.
It's going to be whatever
yield minus like a quarter of the T-bill yield.
Yeah,
basically,
pretty
in 1
much.
year,
It's gonna be priced via market forces and no arbitrage or whatever the interest rate is for no risk borrowing at that duration. You got it.
And then what about the ETF structure enables it to be tax advantaged?
Well, so I can't remember what year it was, and this is super detailed weeds, but basically, Innovator, the guys that came out with all the new ETFs that do like defined outcome things. I'm not sure if you're familiar with those, but they actually went to the.
I'm not. I'm an ETF noob. I wish I had more knowledge on ETFs, but I figure you're the guru of it, so why not talk to you?
Yeah, that's why I was asking you, because I'll make sure I'll give context, because sometimes I just assume something that's common knowledge, and then people are like, what are you talking about? So just interrupt me if I'm saying something that doesn't make any sense. So
I will do that.
There's this firm, I think it's called Innovator Capital, I don't know the exact like LLC name, but I call them Innovator. They came up with the whole defined outcome ETFs, where basically you use options to create different payoff profiles that certain investors might find favorable, right? Like, hey, you're going to get the S&P on the upside, but we're going to up to like 20% return, but we're going to cap the downside at negative 10%. And obviously all they're doing is like trading different option spreads around, S&P 500 or different assets. And this is a very common...
I hear this pitched a lot in like, just like, high net worth pitches, right?
It's in structured product insurance world. This has been around forever, right? And the huge advantage of insurance, which maybe you may or may not be aware of, is they also have a unique tax structuring, right? Like, because they turn something into an annuity, and basically it can compound essentially tax-free, and then when you're 59 and a half, you can take it out and then you pay your taxes. So it's basically a compounding vehicle. And they sell these structured products that do all these different like defined outcome things, right? And so I think that guy's name, Bruce Bond, can't remember the founder of Innovator, I think that's his name. Someone could fact check me, but he basically had a genius idea. He's like, why aren't we doing this in an ETF, right? ETFs are all about low cost, transparency, and tax efficiency, and insurance is basically the opposite. So let's disrupt these boneheads in the ETF wrapper, right? And so one of the things they also did really well is they went to the SEC and they said, hey, can we get in-kind treatment on options? Because it's going to be way more tax efficient and way more cost efficient for the ETFs to operate if we're allowed to do the same thing we do with equities to minimize tax drag. We should be able to do that with options, right? And they sent this very beautiful no action letter protest to the SEC, and they agreed to it. Why is that important? Well, what that means is now, you got to do all compliantly and all this stuff. But now, just like in equities, if I have a low basis security and I want to rebalance out of it because I don't want Microsoft, I want Exxon, I can do that trading through baskets without having to distribute a capital gain. Well, now you can also do that with options, right? And so now a lot of strategies that traditionally have like huge tax drag because you're generating all these different transactions and capital gains, we could use this same technology, which is not near as developed as it is on the the equity side of the house, but it's now plausible. And we could use that combined with like box spreads and what have you to basically deliver, just like you do in equities, a much more tax efficient way to capture, what's essentially kind of like a T-bill type return effectively. And,
so let's say I'm a listener that's sitting on some concentrated position in Tesla or Apple or something like that. How would I go about contributing that and either diversifying or turning it into another vehicle while avoiding some gains.
Yeah. So here's the problem. Well, first problem is I know way too much about this, so we're going to geek out here on this because we deal with this question all the time in real life. So essentially, if you have a single stock massive position, which is call it zero basis, you're somewhat limited. There's one solution called an exchange fund, not to be confused with an exchange traded fund, but those typically require a 7-year lockup, contribution to like a limited partnership, tons of fees, tons of bells and whistles attached. And it could be a good solution, but it's very complex, very expensive, and not exactly easy to deal with. That's solution one. The other solution is more and more people are coming out with long, short tax loss harvesting. So, for example, like Quantino is a firm I really like. I think AQR is doing that. And what they could do there is they basically run like a market neutral strategy. And then, because it's long, short, because you're using leverage, a lot of times with a little bit of capital, you can end up generating a whole bunch of capital losses, right? You're building a lot of unrealized gains on the other hand in a diversified portfolio mix, but you can generate a lot of losses, which then as you generate those losses, you can then start to pare down your long only position.
You just hope they're long term, right? You want to match the losses.
Well, yeah. I mean, at some level, yes, but in the end, it doesn't really matter because even a short-term loss you can mark against a long-term cap gain if you got the problem. So those are two probably the most traditional, or you just donate it. That's another solution. Like, at least, I'm not going to pay the government. I'd rather give it to, Joe or Susie's foundation. You can always do that as well to get rid of the problem. And then the other solution, which is ETF related, which is actually something we specialize on the infrastructure side, is you can do what they call a 351 exchange. However, within 351, which is a section of the IRS code, 351, the IRS is not, and Treasury is not that crazy. And there's a specific line for funding of a RIC, which is a regulated investment company, which is what an ETF or mutual fund is going to qualify as, right? And so in a standard 351 deal, if you weren't trying to fund a RIC, you could take your zero basis Tesla, dump it into this new C Corp, and not pay tax on that transaction. But of course, I'm sure because someone tried to exploit this at some point, they're like, nope, for RICs in particular, if you want to tax-free exchange into a RIC, i.e. like an ETF or a mutual fund, you can only get the tax-free treatment if you contribute diversified property, i.e. you can't dump only Tesla in. However,
that's smart of them.
But let me define what that means because it's
what's diversified?
Yeah, exactly. Because like anything, devil's in the details. So diversified for 351 purposes is the following: no single security can be over 25% of the NAV contribution. So you could put a big chunk, you could do technically 24.99 of something, but then there's another limitation, which is that basically the weight of your top 5 securities can't be more than 50%, right? So if you have a portfolio that's got a bunch of chunky winners with low bases and some like randos in there or like other ETFs or diversified property, you can certainly get a lot more diversification than what like a 5-stock, 10-stock portfolio looks like. And if you dump it in an ETF, you could then, through the in-kind mechanism, rebalance tax-free into more actual diversified portfolios. But that's the technical limitation if you went that approach.
Can you defer the taxes? Like let's say I wanted to flip Microsoft into QVAL.
Yeah.
Can I do that through just as long as I'm not contributing a ton of Microsoft?
Yes.
And nothing else.
So let's say the following situation were to happen. You have 24.99% Microsoft. I'm just making this up. 24.99% Microsoft, 15% Apple, and 10% Tesla. And then a whole bunch of random crap, right? You could say, hey, I'm going to set up a new ETF via 351, and I'm going to contribute these 3 positions and then these 20 other positions that are under 5%. We're going to get that converted tax-free. And then to the extent in your investment objective, it makes sense to like get rid of Microsoft and go into QVal. Like obviously you can't just do things willy-nilly. It'd have to be...
You do it within the ETF that you set up.
And then within the ETF, if you wanted to do that, because it was aligned with your investment objective or whatever, you would just say, hey, Wes, can you please get rid of all this crap and go buy QVal? That would be fairly straightforward to facilitate in a tax-free manner. So, you know, because that's...
Then you have an ETF of ETFs, like a fund of funds, but not...
Yeah, you could do that. I mean, the trick, there's two tricks with ETF. ETF is an open secret, the ultimate tax-free compounding vehicle of all time. Like if Warren Buffett could restart his life, I guarantee he would have started with an ETF structure because it's basically replicating what he did, but with way more, it's just a lot cleaner. The other problem people have, you know, in the end, once people learn about the power of the ETF compounding tax benefit, they're like, crap, how do I do that? But then they have a second problem. Well, the issue is that I'm rich and I have a bunch of low basis assets, but how am I going to get to the ETF? Like I'm stuck in all this crap that I've owned for 20 or 30 years. And I would love to do an ETF, but I can't get there without paying tax. And I like to keep deferring. So that's where this 351 solution comes in. That's a tool of how do you get current low basis assets into the ETF structure tax-free, which has limitations. But now once I'm in the ETF structure, it's easy in some sense to like keep the compounding game going on, you know, until obviously you sell your ETF or you die or whatever. But so that's the trick, is how do you get assets tax-free into an ETF? And then once they're in there, now we're home free, you know, within limitations, of course. But if you're trading equities or tactical, it's pretty easy to not distribute capital gains.
What do you think the minimum asset value that you would need to have in an ETF is to have it make sense?
I mean, well, basically for brain dead, like not reinventing the wheel ETFs, it's basically around 200K all in costs. We got actually a little bit lower than that. So if you're thinking about it, you know, and so if you look out to the market for what does it cost me to buy a deferral now, it's usually insurance is your next best alternative. And, you know, if you go buy like a variable annuity on, you know, it might be anywhere from 25 to 50 basis points or higher, depending on your scale. But let's just say to do an ETF, the cost is 200K a year. Well, if you have 50 mil, that's a 40 basis point carry cost. If you have 100 mil, that's a 20 bip carry cost. If you have 10 mil, that's a 2% carry cost. So what I usually tell people, if you're in it for tax only, which nobody should ever be in an ETF only for tax reasons, you know, usually 50 mil is probably like a minimum, right? Because that's a 40 bip carry cost. That's actually pretty reasonable for like a deferred tax compounding wrapper, especially if you have any sort of activity. And then anything above that, it just gets better and better and better and better. But of course, not everyone just does the ETF 100% for tax reasons. It's also, you know, you got like a ticker on an exchange where anyone that thinks you're cool could be an owner, right? I mean, there's a lot of other reasons from like a business perspective, liquidity perspective, beyond just tax why you would do that. And actually, I forgot one other way, because I actually live in Puerto Rico, do tax stuff down here. There's another way you could also diversify single stock. There's a thing called Act 60, which used to be called Act 2022 in Puerto Rico, whereas if you have $1 billion let's say you have $1 billion of Microsoft with $0 basis, if you were to move to Puerto Rico and live here for 10 years and establish, like basically, I can't remember what the technical tax term is, 100% of your basis would be converted into like your Puerto Rico residency. And so you'd only have to pay 5% tax at the 10-year anniversary to the Puerto Rican government, which ain't bad. So you can't get rid of all of it, but it's almost a step up at minus 5%. So that's the only other way I know.
How do you like Puerto Rico?
What's that?
How do you like living there?
I love it, man. I never leave here if I don't have to. I spend
That's awesome.
90% of my days down here. Only when they, you know, got to drag me out for dog and pony shows or shake hands, kiss babies events, I'll leave this place. But I love it, man. I think it's great.
That's cool.
But
I got a buddy down there. Shout out to my man Francisco.
Yeah, there we go. It's a great place. Not for everybody, but I highly recommend it if you kind of got a little adventure spirit, you know, can speak a little Spanish and just like being adventurous and checking out new things. It's high recommend.
So when do you move?
I moved about 3 years ago. I moved during COVID times.
Nice.
I was finally able to, there was about a year there where social networks were broken. And so my kids didn't hang out with their buddies. My wife didn't hang out with her friends. And I was like, this is a silver lining. This is an opportunity to make a change.
Yeah.
And so and then also like the work from home became less of an issue because people were like, oh, that's actually a good idea. To which we were like, well, no kidding, it's a good idea. We've been doing it our whole lives. And so it was like a lucky opportunity where I was able to pivot, and we just jumped at the opportunity. And there was also a time when our business was just in a massive convexity change because we were hitting like the 10-year overnight success problem, where it's like 10 years eating ramen noodles, and then we're like, oh my God, we're getting rich, guys. Like this actually worked. But now I had to get my tax structuring in place. And so it's just all the stars aligned in this situation.
That's awesome, man. Good for you.
It worked out.
So how did you start in the industry? Let's talk about the 10 years planting the seeds.
Yeah. So, I started in the business, like seriously trying to be an investor, like in 99 at the height of the tech bubble. And then obviously I thought I was a genius because I was a Warren Buffett, Ben Graham Bible thumper back then. And I don't know if you probably remember that, but like if you threw a stick at a small cap value security, you made 30% a year for 5-6 years in a row there. And it's hard to not think you're a genius in that sort of environment. And so, I think I launched some fund with like $1 million or something, maybe is probably in 2002 or 2001, like when I was a senior in college and I went right into the PhD program. And then, eventually I was like, all right, I got to get out of finance and join the Marines. That's another story. But when I came back in 2008, I then also launched a hedge fund in September 2008, which obviously was a total disaster. And then, kept going on, kept grinding. And then my third business attempt in 2010 was the current business. And that one basically started because I used to write a blog, like we still write a blog. It was just way worse and not as good back in the day. But I literally got cold called by a billionaire who had read my blog and had read my dissertation. And that was after 2008 when everyone got like kind of fleeced in hedge funds. And he basically just said, hey man, like I like your stuff. I want to talk. We're transitioning our family office out of hedge funds and LPs because we need to control our wealth, go quant, get the costs down, blah, blah, blah. And so they were way ahead of the whole curve on where the world was going anyways. And so basically we started the current form of the business up, and then we did a couple years of consulting, due diligence for just on other managers and helping them build their systems out. And then in 2012, just because this is what I'd asked for, I was like, hey man, like, can you seed us? Like the first time I've ever met a billionaire. He's like, yeah, I can, but let's just work together for a little bit. And then we got like a 50 mil seed in 2012, basically for quantitative value, that strategy. And then kind of the rest is history. And it's just grinding it out. And then we learned about the ETF. We started off in managed accounts, and then we learned about the ETF. I was at some rich person conference. Some lady was telling me about it. I was like, wait a second, that sounds like the biggest tax shelter I've ever heard of in my life. And I did more research into it. And I was like, holy cow, this ETF wrapper, why would anyone even run a managed account? And I told it back to the billionaire guys, and they're like, well, yeah, duh, let's do that. And so we basically converted our SMA business way back in the day into the ETF business because it's just, it's a better way to manage capital in equities. And that was probably around 2014. And then just grinding it out ever since. Yeah. That's awesome. Yeah, it's not that exciting. It's just,
No, it is exciting, man. This is so, I call this show, I call it the Business Brew. It's supposed to be like, I always thought about it like brew, like you put a bunch of stuff in a pot of coffee and then, you end up with the coffee cup. I think a lot of times people look at the end result and they don't realize what went into it, right?
Yeah.
And they don't realize the grind that it took to get there and how long. And I mean, you launched QVal, what, like right in the teeth of a value headwind,
Yeah,
right?
we
So
launched
that's
that
not
at the
exactly
top, unfortunately.
from a timing standpoint.
Yes, and we have been like in 2017, we had $1 billion under management, and our average fee was like 80 bips. And then all of a sudden, the factors really blew out, and we dropped fees, and the whole ETF wheels were in motion for the future. And so we went from like kings of the castle to like damn near bankrupt and like refighting again to get to the top of the hill. And then COVID happened. So then I got another, as you know, value got destroyed in there. And unfortunately, I had like one of my main business partners commit suicide around then. So I've been many times like at the top of the hill, right to rock bottom, probably 3 or 4 times. And then this time, we've got so much escape velocity. I mean, I don't even know how we could get taken down at this point, to be frank. But, there's been many, desperate times of highs and lows on this journey. And honestly, I don't know, looking back, if I recommend entrepreneurship to most people. It's just too risky, man. Like, and you got to be damn near crazy and nuts, which, I used to be in the Marine Corps, so I had good training to, to deal with pain and anguish and emotional issues. And so it worked out, but it's like they threw everything.
How did it help you?
Well, I think just, one of the things about the service, and I was like obviously in combat and everything. And fortunately, during a time where a lot of people get killed and died, and like you start realizing like, wow, like, life's special and it's fleeting, and you could be dead in an instant. And so once you live through kind of those experiences where it's like as raw as it could possibly get, and you come back to the civilian world, you're like, dude, this shit's easy, man. Like whatever. And so when you just go through like the Marine Corps and you go through that sort of training, that sort of like experiences, everything is just, you don't stress out much. Well, some people do. Some people, it affects them and it actually makes them worse because they're too distracted. But some people, it just makes them harder. Like I wouldn't say necessarily it's a good thing, because I know like guys like me, we're kind of probably warped, honestly. But it's good in the sense that you're just so hard, shit just, goes over, you just don't sweat it, and you can grind through anything without even thinking about it. And so that just mentality is very useful in situations where like you thought you were a stud and now you're a total dud, but you keep grinding no matter what, and you just don't give up. That's just a good mentality in asset management, where it's a freaking roller coaster times 10. So it was useful for me, for sure.
Might be easier for you, but as an entrepreneur, you still got a family, right? So
yeah,
you're taking your spouse to the mountaintop and down.
Yes.
So
you
still got to manage that.
Yeah. So the way I always tell that, because now all I do is talk to entrepreneurs all day on our infrastructure side. And my number one advice is this is a team effort. Right? If you have a wife and you have a family, or vice versa, you're the person launching ETF, you have a husband, a family, whatever it is, it's a team game, and you can't get margin called by your family. And I've seen it happen many times where like the entrepreneurs got the mentality to grind for 5-10 years, but eventually your significant other and your children are like, dude, like we need to eat, bro. Like you need to go get a real job. We're out of this. And so it's really important that you think through that you have like, you make sure the family margin call is covered. And so in my situation, I had the cheesiest gig on the planet called being a finance professor, where I basically got paid a lot of money to not work that much, and just my work was doing research, which is perfect because I'm doing research on stuff I would research anyways if I was going to be a practitioner to develop new investment strategies. And so I'm making all this money and getting paid, but I don't have the issue of like, I got to work 100 hours at my job, and then on the weekends when I'm trying to hang out with my kids, I'm trying to build this business. Because honestly, that's just not realistic. It's too risky. So so I always recommend either marry well, so your spouse can like float the boat, or be born rich, which is also a great way to do it. But you got to be in the lucky sperm club. or find a job where somehow like your job is kind of related to a lot of what you might want to do as an entrepreneur. So, for example, if I'm like a business development, like raising capital person for Joe Schmuckatelli asset manager, that's a great skill to have, because in the background, I might be geeking out on strategies and like things. And I'm like, all right, if I go be an entrepreneur, this is way easier, because the biggest skill set you end up needing is like how to market, distribute your product. Because even if you have a great idea but no AUM, nobody cares. And so, you just want to make sure that, and it's not easy, by the way, but you got to cover the family margin call, because it's just unfair to your constituency, whatever that might be. They get a vote in it too. So we want to make sure you stay, or just get VC. That's what VC and PE is for as well, where if you raise capital, someone else is kind of like funding that risk on your behalf. So at least, you can get a decent salary and pay your bills and eat food, because no one is going to be effective if they're always stressed out and worried about paying for food. You're not going to be a good entrepreneur in that situation. So, yeah. But, just time.
What are the common traits of people that you've seen that have made it?
So you have to be kind of ornery and bullheaded, obviously. Like, you can't give up. You have to believe no matter what people say. Like, basically be overconfident, effectively, is probably the easiest way to say it. That's a necessary condition. That may not be the nice way to put it, but you got to be very overconfident / passionate, whatever you want to call that. And then also have long horizon and make sure your funding is correct. Like, you can't be getting like margin called. So, at least a 5-year, maybe if you're going to be an asset management business, I'd say a 10-year horizon. That's the whole point of 10-year overnight success. So yeah, just grind it out, overconfident passion, long-term horizon, and just willingness to basically just grind it out and do the boring shit over and over again, and just have faith that as long as your process is good and as long as you're adding value in whatever you're trying to do, eventually people will recognize that and it'll happen. But it's not going to happen overnight. But it's really simple.
Yeah.
And then you need luck, but you can't control luck, so you can't really calculate that. Everybody needs luck, right? It's like I've ran into that situation where, we climbed the mountain and then we went to the bottom of the mountain and then we kind of got luck. So we're unlucky when we got booted off the mountain, but then we caught a break, and that's what allowed us to climb back up the mountain. But, if I only got bad luck breaks, you're never going to be successful, right? It's like trend following, like a negative value asset. Like, you're just going to go to zero if you don't quit at some point. Because if you just have bad luck at every single turn, no amount of good entrepreneurship or grinding it out or grit or whatever you want to call it is going to matter. You got to have a tailwind at some point.
I like it.
Yeah.
That's neat, man. Good for you. I've been looking at QVal. If assets chase performance, I can understand between BOXX and that, and maybe some of the other things going on, why you have hit escape velocity. But nevertheless, there's still some stink on value. I have questioned it myself, although not in a huge way. But I think people that listen to Value After Hours would say I'm less value-y than certainly Toby.
Yeah.
One, do you mind talking about your definition of value? Because this has come up on Value After Hours a number of times, and they've told me like 3 different times, but I don't fully understand where you how you rank value within category.
Yeah.
And then 2, I know you went on an exploratory, why will value not work last year? I saw a couple of those tweets. You mind sharing some of your conclusions about whether or not the arguments against value have any merit?
Yeah, sure. So it's very important, to your point, to define what is value, because, it has a million definitions. It's in the eyes of the beholder at some level. So in our particular context of how we implement value now is like Toby and I are very aligned on 99% of this thing. And I love him because he's so hardcore and just holds the line, which is amazing. I obviously believe in some other tools in other religions, but I'm also a big hold the line Spartan on value like he is. But he's like the poster boy for that. So God bless him. But our version of value and approach is one, systematic. Because I used to be a stock picker, like, didn't work. I realized very quickly that I suffer from behavioral problems like everybody else, and no amount of anything can ever solve that problem. I'm just too much human. Systems solve that. So whatever the hell we're going to do, it's going to be done with a computer, period. Second step, I'm also a big believer in the fear aspect of describing why value works over the long haul. What do I mean by that?
Yes,
I
agree
believe
with
that
this.
value is this idea of buying stuff that everybody hates. It's Ben Graham style value. It's not Warren Buffett. It's like, where are all the dirt balls, the terrible stories, the just wasted, barren turds of the market that are really, really cheap? I want to focus there because I believe on average, expectations would change from being fearful and maybe not being greed, but just not being so scared of these damn things, right? You're going to get meaner versions of expectations, and that's when value will start to make money, right? Because it's all about, you only make money if you can outguess the current expectation in the price. So I think fundamentally that's my style of value. Just buy a lot of cheap stuff with a computer, and then kind of one little area where Toby and I think have a little bit of difference of opinion is within the dirtball cheap stocks. I like to focus on quality with the idea that, okay, I'm buying dirtball cheap stocks everyone hates, and obviously there's some issue with their business. Otherwise, they wouldn't be in the 10% cheapest stocks. Like, duh, the market's not that stupid. So that what that means is if I want to capture mean reversion, I need to make sure that these things can at least last for 3 to 5 years. Right? Because if I buy a dirtball cheap stock that's really cheap, but fundamentally this thing is a dumpster fire and they might go to negative earnings, they're never going to have the opportunity to get a mean reversion, and they could go bankrupt, or they could be like the falling knife problem. So intuitively, I just like to add quality fundamental overlays amongst the cheapest stocks. I think Toby is more preferential for just straight up dirtballs, which actually I don't mind either. It's just at the margin, I like to add the quality overlay. So for me, it's this simple. I like to buy the cheapest, highest quality stocks. Cheapest is priority, but within those, the highest quality. And I'm doing that with a computer. And that's basic QVal.
How do you define quality?
So, I mean, we just use an assortment of things, right? Like we have like a little 10-point checklist now, but it's things like, hey, like, is your year-over-year earnings, operating margins improving? Are you buying back stock? Are you paying down debt? Like just kind of good old-fashioned Ben Graham ideas. Just fun. Like if you were to go look at like security analysis and just go flip through random pages and grab 10 of those, stuff like that, right? Like, are you making money? Are you financially stable? Are you getting operation improvements? Are you doing net repurchases? Because usually that's a good sign amongst cheap stocks because, presumably the C-level guys are being smart about that. Just, common sense quality. And, we have our methods, and we use a bunch of like negative screening mechanisms on the top of the funnel as well. But whatever, if you don't want to do a super fancy version like we do, if you just said, hey, I'm going to buy the 10% cheapest stocks on PE ratio and make sure they don't have too much debt like an old Ben Graham screen, also a great idea. Like, God bless you. I'm in. So that's for me is value. It's just the greed or it's the fear trade with this idea that eventually, fundamentals will mean revert, perceptions, sentiment mean reverts, and that's when you make all that money, right? So,
how do you avoid catching like cyclicals, like peaking cyclicals?
Yep.
Or do you?
So that's frankly, that's part of the trade, right? And the issue with long only value investing, long short is very different because now you got a risk management problem, right? Like I can't be long energy and short tech just vaguely because there's a good chance I'll go bankrupt before anything works, right? So in a long short context, which is very different than a long only, you have to sector neutralize. You have to do all this crap because you're in the risk management game because you're basically running a levered portfolio. In a long only context, the issue is sentiment and hate and discontent is highly correlated with sectors and industries, right? And I always use the example of like 99. Like, okay, so we're going to force ourselves to own 50% tech, and the cheapest tech stock is a 50 times price to earnings ratio. That's not going to work here, right? So you have to, unfortunately, take on tracking error, because value, like the whole thing we're talking about, is highly, highly correlated with sectors. You're going to find the vast majority of dirtball, cheap, hated securities in sectors generally. It's highly correlated, right? And so that's just the fact of the matter. Now, on the cyclical thing, that's part of the trade, because that's the reason they're so cheap, right? Like the whole point of value investing, at least how I like it, is I'm going for expectation mismatches. Where this firm, energy is the greatest example ever the last few years. These firms are making more money than God. Nobody cares. They'd rather pay 50 times revenue for whatever, NVIDIA, I guess.
I would not.
Yeah, but I mean, that's the pitch, right? It's like, well, these energy guys, they're making all the money, but we're ESG. We're going to all do everything with wind tunnels or wind farms now. I don't even know what the pitch is. It's ridiculous to me. But all these things, they have this like overhang of, oh, it's cyclical, they're going to be dead. Meanwhile, all they're doing is printing free cash flow. Like, to me, if you buy that at the right price, even if it mean reverts, like even if it does what they say, as long as it doesn't, fall as bad as what people had priced in, you still could make money, right? So even if, let's just pretend half of energy goes to wind farms, Exxon is still printing dollar bills, and they might even own the wind farms now too, right? And so yes, maybe their earnings like slow down or they're cyclical, but if you bought it at such a cheap price where the hate and discontent suggested that Exxon's going out of business, you can still make money, right? So yes, it matters. And we've looked at everything you could ever imagine. Like, we're like, hey, let's do averages. Let's do CAPE ratio type earning look backs. None of that shit matters. What matters is what's in the operating income the last 12 months. That is proxying for this mispricing element on average over time. And the cyclicality is part of the trade.
Well, you and Toby are very, very close, as you
What's
said.
that?
You and Toby are very, very close, as you said.
Yeah, exactly.
Right? He's EV to EBIT. That's basically the same.
Yes, exactly. And I do believe in some sort of diversification. Like, I would never recommend, like, okay, the cheapest stocks, 100% of them are in, like, the oil patch. Let's do 100% that, because that's just, if that's the only investment you have, it's just too much idiosyncratic risk. I would agree with that. But if you want to capture the value premium, you have to allow a lot of flexibility. So we have like, I think 20, 25% bounds where you could be way off whatever the S&P is, but you're never going to be like 50% in one industry, obviously. That's even too crazy for me. Now, you could argue you could go pure all in, no matter what, unconstrained, but you'd only do that if you also owned, some SP 500 or other crap. If it was like your only investment, that would be kind of crazy. And even like Warren Buffett and concentrated stock pickers don't do that. So,
well, you just introduce massive path dependency to something that otherwise doesn't need to exist.
Yes, exactly. Right? And there are industry risks too. Like they could just turn off an industry. The government could just say, nope, you're not playing anymore. And all those cheap stocks are now really cheap because they're worthless. So you want to have obviously some diversification to avoid like crazy tails like that. And there's a lot of different opinions on this. We're like Toby. We're going to go as pure as humanly possible within reason and just go for it. We're not here to benchmark hug.
See, I've said a couple times that I might just index on this program. I have not spoken precisely enough. My real answer is I have come to, I feel like an idiot saying this out loud, but it's true. I've come to really appreciate the tax benefits of ETFs.
Oh, yeah.
Because it really sucks when you're really right on something and then you got to stroke a check to the government. Or you got to own something that's like not cheap anymore and you're looking at foregone opportunity and it's like,
Yes.
All right, if this is one of the few businesses that can grow to the sky, this can work.
Yes.
But if it's one of the 95% of normal businesses, I got to get out. And if I got to get out, I got to pay taxes. And that
I'm
sucks.
telling you, I spend 99% of my time figuring out tax structuring, 1% on the strategy. Why? Because the tax is like a 50% carried interest around your neck. That dwarfs so many other variables. I don't understand why people don't think about tax so much more than they spend on investment.
Well,
It
because
matters.
because most people, or at least a lot of people in the industry, don't have the same incentive that you do to tell the same story. So that story is not what people are hearing or thinking about as often.
That's true. It's
is my
very
answer to
not
that.
transparent. Like there's not like, I mean, Morningstar tries to do after tax, but it's something that's just, it's not discussed nearly enough. But yeah, obviously an ETF, like it doesn't matter what you put in it, but if you have any level of activity, the ability to compound tax deferred for 20 or 30 years versus having to pay taxes every year, and the optimization problems like, well, I have to own this overvalued turd because that's better than paying the tax on it. Like the ETF just eliminates that whole problem, which is beautiful.
Yeah.
It's like you have a massive 401k where you could just invest optimally, like what makes sense to compound capital. So yeah. But the downside is, and we obviously know a lot because we have a huge business, is launching an ETF is not exactly easy or cheap. It's 200 G's a year you light on fire, minimum. So you got to have like pretty serious capital to even consider that. You already got to be rich. Well, how do you get rich? Well, you get lucky and you probably didn't pay taxes and you compounded at a high rate for a long time. But
Yeah.
people that are trying to do it, your next best alternative is probably just buy other people's ETFs that are close enough to what your investment philosophy is that it's not going to drive you too wild.
Yeah, well, and to your point, if you do buy other people's ETFs, then they've already lived through the ups and downs of entrepreneurship. Some of that may be worth outsourcing.
Yes, exactly.
Right? Like it's not all, it's easy to look at the gravy train at the end and be like, I want that. You got to be willing to live through the cost.
Yes, for sure. But that said, just because I'm biased, because obviously I have ETFs, like if you do have the passion, if you do have the desire, and you would do this for free and just because you love the game so much, I get it. There's people out there like that. Like
Yeah.
I'd probably do that. If someone gunned to my head said, hey, you're not getting paid shit anymore to run Alpha Architect and do your business and do everything you do, I'd probably still do probably 95% what I'm doing right now. I'd be mad. I'd probably whine and complain a little bit, but I'd be like, whatever. I like doing that anyway. So then that's when you're kind of programmed to, this is probably the right idea. It's just kind of what you wanted to do. You were born for this type of thing.
Can we talk about another church that you seem to pray to, which is Momentum? Well, listen, can we pick up part 2 of this?
Let's do it.
Well, thank you for taking the time here. I appreciate it.
Yeah, no worries. At this time of year, we always host a lot of people because it's, 80 degrees and perfect weather in Puerto Rico. So we magically find ourselves with like hosting barbecues every night and drives my wife insane. But, is what it is. Cost of doing business if you live in Puerto Rico.
Nice to live somewhere that people want a vacation.
Yeah, exactly.
All right, so I wanted to ask you about your other church that you pray to. I know that you've found, statistical outperformance historically in value. The other book that you wrote was about momentum, and I'm curious for your thoughts on momentum or what you found with momentum strategies.
Yeah, so but as a native value investor, you're kind of taught that all that matters is some fundamental to price, and you shouldn't just focus on price or technicals or any of the Mr. Market aspects. But then the problem is when you start reading enough research and you're trying to be an evidence-based investor, not a feelings-based investor, it becomes pretty clear pretty quick that momentum is something you should strongly consider. And so it took me a while to wrap my head around it, but momentum is this idea that just buying winners. So stocks that have been doing well relative to all the other stocks continue to do well in the future. That basic concept is arguably one of the best strategies that you can do, arguably even better than value. That doesn't mean you should not do value, because they happen to kind of yin and yang at different times. But that's essentially momentum. And again, for me to get there, it took a while, because I was fundamentally, still am, a value mentality type person. But now I'm a believer in both.
How persistent is that momentum? I mean, do you pretty much just say, okay, well, if I'm going to buy into that, as soon as the moving averages cross over, I'm out, or something like that?
Yeah, it's less persistent in the sense that if you do a generic value strategy, like let's just say, hey, we're going to go buy the 10% cheapest PE stocks or something like this, it doesn't matter too much whether if you rebalance that every month or every year, you're still going to capture the effect, right? It's obviously better if you did it monthly rebalance, but then you got to consider taxes, fees, and all this other stuff, but it still works. With momentum strategies, if you don't refresh them quickly, they're worthless. So like, for example, an annual rebalance momentum strategy is all but a waste of your time, whereas it only works if you have faster frequency. And that kind of makes sense, because it's more of like a sentiment, you're basically front running people that are chasing shiny rocks all the time.
Yeah.
And shiny rock chasers change their minds a lot. And so it's really important in that strategy to it has to be a much more actively traded strategy. We're doing it monthly now, but even quarterly, it's still not bad.
Interesting. I mean, it makes sense. The other thing that I think is sort of nice about it is momentum can move factors, right? It kind of morphs with whatever is working, I guess.
That's
is
true.
how I think about it.
Yes, we do live momentum strategies. And in, I think, whatever it was, 2020, 21, we were like a Cathie Wood clone. And then, after that momentum blew up, obviously because we do momentum strategy, you quickly shift. And then we were an energy fund in 2000, late 21, 22. And so momentum, the best way to think of it's like a chameleon. Like it's just where the chameleon colors change depending on where the mojo in the market is. And it just adapts. It's a very adaptive strategy. It can be anything to anybody.
Yeah. Yeah, well, as you said, it's whatever the shiny rock is of the day, right?
Exactly. Whatever has momentum, that's what you buy. It's really a pretty brain dead strategy that's not very intuitive, but it just works, I think, over the long haul.
Huh. Well, I really appreciated, the work that you put out, and I appreciate you expanding my mind a little bit about, I read the DIY Investor. I had all your books are like right there on the bookshelf together. So I think I found you in like 2019, and I appreciate what you've done.
Hey, yeah, I'm sorry that I've contributed to your brainwashing in the financial markets, but hopefully some of the knowledge is useful.
Indeed. Hey, I wanted to circle back to something that you said about Buffett and an ETF. And why do you think Buffett would have been in an ETF structure? And the reason that I ask that is I'm kind of curious if the momentum, like it seems to me that ETFs can attract money when they're working, and I'm not sure if that would be a positive in like Buffett's strategy is kind of what I totally get it from a tax perspective, but I was just curious.
Yeah,
to hear you think about it.
The main reason I mention that is just, if anyone follows Buffett, you kind of realize his genius is not really picking stocks. His genius is lowering frictional costs and avoiding taxes. That's what has allowed him to compound, not just at high rates, but high rates after fees and after taxes. And obviously the ETF is basically the ultimate way to achieve both of those. Now, to your point, which is actually a very good one, ETFs are not permanent capital. To the extent you're on board with Buffett's strategy, you give him more money, he deploys it. To the extent you think he's an idiot, you take capital away from him. However, that said, like the nucleus of the core strategy itself, and to the extent you didn't give him too much money, so he would have too much scalability and not be able to play with the things he likes, which is actually his current problem, I don't think it would actually matter. It's just the end investor could screw themselves. But Buffett himself is just going to be managing a pool of capital and investing whatever pool of capital he's been given, the best of his ability. And if people want to ride the train, great, they can ride the train. If they don't want to ride the train or they want to get out at the worst times, obviously you cannot control that. It's not like permanent capital stuck in the fund, and that's their own problem. But I still think it would still be a pretty useful vehicle for someone like him. for sure. Especially to the extent he's trading in things that are relatively liquid and scalable. Now it might be too much because he has, hundreds of billions of dollars, and there's too much transparency in an ETF. So at that scale, if he's being super concentrated and he's trying to buy like huge stakes as a percentage of the business, that's obviously not going to work in an ETF structure because there's all kinds of limitations and issues with the 40 Act. But taxes, frictional cost, and early day Warren Buffett, I think he would definitely at least strongly consider that wrapper.
As far as people like considering that wrapper, one of the things that I had asked you about when we were getting ready for this, I said, I'm curious for your more interesting ETFs ideas or whatever. Like, what are some ETFs that people should think about or may not know about is probably the better way to say what I'm trying to say. And one of them is you brought up, you said the interesting deals are less about the substance of the ETF, but how they became an ETF. And you cited CCMG. And I was curious if you wouldn't mind just briefly describing what that is. And if somebody that's listening, if this kind of conversation resonates, you want to talk a little bit about your business on how you're helping people launch ETFs.
Yeah, so CCMG is one of the most recent conversions we've done where you can always launch just a normal ETF, just you start up an ETF and you hit the ground running. But there's also an ability to seed an ETF tax-free with current assets, typically low basis assets. And we've done that on mutual funds, limited partnerships or hedge funds, and separately managed accounts, typically through like an RIA. And so the CCMG deal was a monster SMA deal where there was, thousands of individual separately managed accounts that were syndicated all together with low basis securities that all contributed simultaneously to seed an ETF. In that case, it was almost $800 million. But we've also done mutual fund deals that were almost $1 billion. And we've done several LP deals that weren't that big, but we did one that was over $100 million. The main idea is that, a lot of people look at the ETF wrapper, they're like, man, that's so awesome. The tax efficiency, the fees, the transparency, like that's clearly the future in many respects. But, I have a bunch of low basis stuff right now, and I don't want to sell that, pay a bunch of tax just to get into the better wrapper. And so what we've kind of focused on our ETF structure is how do we solve that problem? How do we transition you from A to B, where A is the inefficient way to manage capital, B is the efficient way to manage capital? How do we do that without having a tax bill? And so that's something that's super interesting for if you do have listeners out there that are, investment advisors, hedge fund managers, or even just ultra high net worth, and you'd like to manage your money in an ETF because who wouldn't? But, how can we do this without killing you on the way into the ETF wrapper?
Yeah. I am thinking of somebody right now, and as soon as we're off this, I will at least ping him and maybe actually write just an intro and say, hey, I think you guys should chat, because especially if you can convert mutual funds, that seems to be a way to take what I perceive to be sort of a dying business and flip it into more of a growth strategy.
Yeah, 100%. And obviously the devil's in the details. These things, there's way too many lawyers involved. So it's frictional, it's painful, tons of brain damage. But if you're thinking about this as like a 5-10 year thing and not like the next 6 months deal, okay, so we have some one-off cost and brain damage, but it sets us up for long-term success. That should be a no-brainer for most people. But you do have a lot of legacy and status quo bias, or even great ideas. You're like, we'll just deal the next month. And then you say that for the next month or the next 10 years, and then you find yourself dead and out of business. That's something you obviously want to avoid. But I also empathize with that because it is a pain to deal with transitions and, explore a new business model and deal with ETFs and what have you.
Yeah, but it would be an interesting idea to sort of buy like dying mutual funds and then convert them to ETFs to the extent that it was just the mutual fund wrapper that was causing some of the decay in assets under management.
I mean, there's a business out there. That'd be complicated, but to the extent that you can go in there and get the key like anything is price paid, right? Yeah. Like if you can go in there and buy the assets as they are, which is basically a dying legacy thing that's going to be bankrupt anyways at some point, and you could pay that value and then turn around, flip it, convert it in ETF, and clean things up. But the problem is usually in M&A, like the mutual fund people, when you're like, hey, I'm going to buy your stuff because your business sucks, they're like, well, great. What do you want to pay? And you're like, well, not a lot. And they're like, okay. And then they're like, well, that's weird. Well, okay, maybe we will do it. And then the problem is you need to explain to them, because you need a lot of people on board to convert to an ETF. And then the minute you explain, like, hey, here's what we're going to do to unlock all this value, here's how we're going to do it, they're like, oh, well, instead of paying me what you wanted to pay me, you're going to have to pay me more now, because you just told me how you're going to add all this value. And you're like, well, I'm going to add all that value, not you. And they're like, well, yeah, but just pay me for it anyways. So those deals, it's all about the art of the deal and finding a win-win to make it work. And in my experience, it's just easier said than done. So
yeah, well, that's what you do on podcasts. You just say things that are easy, right?
Yeah, but it is an entrepreneurial opportunity, right? If something's hard, that usually means there's like a return on capital tied to it. And if you can solve that, that's how you make money. So if you have any entrepreneurs listening or people that are out there, I mean, there's definitely a value creation situation on conversion from legacy to ETF wrappers, which we kind of sit as the shovel maker, but someone needs to be the deal maker. And you could definitely make a ton of money if you could get everyone to sit at the table and agree on something. For sure.
How do you find yourself as the shovel maker? Like, how'd that happen?
We do so basically what happened is we never in a million years would have thought we'd be a shovel salesman for ETF infrastructure services. But sometimes life just happens. And we were always kind of like dudes hanging out in the garage trying to survive in the ETF business for over a decade. And we built all this infrastructure, did everything ourselves. And then, you wake up 4 or 5 years ago and now everybody on the planet is like, man, how do we start an ETF? But geez, that's really hard and like tons of costs and super expensive and annoying. Wouldn't it be nice if we could just go rent Wes's infrastructure? Because they already solved this. And then we finally just had to get our head around opening up our infrastructure to other people as opposed to just using it for our own ETFs. And then once we figured that out, it's kind of like, I'm sure it's probably what Amazon thought when like, we built all these servers, we built all this infrastructure to facilitate our storefront. And everyone's like, man, it would be nice if we could use your guys back in tech. And sure enough, AWS was born. It was kind of like what happened to us. Like we had like an AWS basically buried in the backyard, essentially a gold mine that we didn't know we had until we just thought differently about it. So it was just a change in mentality about what's our value proposition in the ETF business. Maybe it's not making ETFs, maybe it's helping other people and selling them a beautiful, low cost, high quality shovel. We might be better at that than actually creating our own ETFs and trying to sell them to the world. That's difficult. We don't have a monopoly on that for sure.
Yeah. Huh. Well, I thought about you this weekend. I had something that didn't go quite so hot. And for those that don't understand what's going on, we ended part 1 and started part 2, and we had a weekend in between. So that's where this comment comes from. And I thought about you talking about your experience in the military, and I said, you know what? If guys are going through that, whatever I'm going through isn't so bad. And, I want to let you know that somebody that sat here and watched, like, you write the books, and I wasn't as close as many were, but it's really cool to see you succeed, and it's nice to hear you excited that it sounds like your business has hit escape velocity, and you seem like one of those guys that's out there doing the right thing for the right reasons. And I'm happy that it happened to you, because I'm happy that you made it happen, and I'm happy that it seems like you guys hit escape velocity. It's very cool.
Yeah, no, appreciate it. Yeah, it's all about having a good team and good people around you, setting a good culture, and we obviously want to give it forward too. So like, if you're an entrepreneur or anybody, I'll talk to anybody. I don't care if you're a billionaire, you're broke as shit, because I've been in that I've been in that position as well. Just feel free to reach out, and we're always happy to help people try to achieve success and win in the game. Which is extremely hard. So all good.
How can people find you?
On the Alpha Architect side, just alphaarchitect.com. On the infrastructure side, etfarchitect.com. And just, hit us on contact us, depending on what aspect of our business you're interested in, and we'll be in touch. It's that easy. Or on Twitter, I'm at, at Alpha Architect on Twitter. Also a common place you can hit us directly.
All right, cool, man. Well, thank you for carving out the time for 2 straight work days, and I appreciate it, and we'll be in touch.
Yeah, you got it. Appreciate the time, and honor to be here.
All right, cool.